Hi and welcome. In this video, we will continue talking about the stock investing. Let's buy a house. To get your mind working, let's imagine that you are going to buy a house. We will think of buying the house in the context of its book value, market value, and its intrinsic value. The book value. When the seller of the house first bought the house, they most likely placed a down payment and financed the rest of the house with debt. Let's say, for example, that they bought the house for $200,000 and placed a down payment of $20,000. In essence, they paid $20,000, the bank gave them $180,000. In simple terms, we will say that the book value is the total amount of book equity plus the amount of liabilities. In this case, the book value will be $20,000 plus $180,000, an equal of $200,000. The market value. Remember that markets determine prices. Let's say we want to buy that very same house in 5 years. By this point, due to a shortage of houses and increased demand, similar houses are selling for $250,000. That same house, even though its book value is still $200,000, now has increased its value and the market has priced that house and similar houses at $250,000. The market value will be $250,000. This is the price that you will have to pay to buy that house. Should you buy that house for the $250,000? Is it actually worth $250,000? The intrinsic value. Now, let's take a deeper dive into the $250,000 market value or will be selling price of the house. You really want to know if that house is worth $250,000. If you determine the house is actually worth $250,000, you will be comfortable buying it. If you determine it was worth more than $250,000, you will buy it in a heartbeat and consider yourself a value investor. What are some things you should look at to determine if that house is really worth $250,000? You might look at the future housing market of that area. You might take a deeper look inside the house. You might look at the condition of the following: the kitchen, the roof, the yard, the appliances, the garage, the bathroom, the rooms, etc. You also will need to take a look at how long that house will be able to support its residents. After you perform a thorough inspection of the housing market, you determine that the house prices will increase over the next couple of years and the house will have a much higher resale value. You discover that the appliances of the house are brand new, the roof was recently been replaced, the yard is in great condition, and everything else seems to be in order with the house. You run a few calculations based on the condition of the house and future prospects of the housing market. And ultimately, you value the house at $300,000. Because of your inspection and belief on the future condition of the housing market, you have determined that the intrinsic value, the true value, is greater than the market value of the house. You should buy the house and consider yourself a value investor. A couple of questions to consider. Number one, why is determining the intrinsic value of a house more difficult than the book value? Number two, what is the market value and the book value of something harder to calculate? Like going to college? What is the intrinsic value of going to college? Let's talk about determining the intrinsic value of a company. There are many valuation metrics and techniques investors use to try to estimate a company's worth. We will teach you two: the discounted cash flow method and the relative valuation method. Let's talk first about the discounted cash flow method. You want to impress someone you know who works in finance? Tell them that you will build a discounted cash flow or DCF model in school today. It's like telling a hiker that you've been hiking Mount Everest or telling an ice skater that you can do a triple axel. Yeah, doing a DFC is really that cool. And today you're going to create one. A discounted cash flows model is one of the go-to ways to investors to measure the value of a company. A company's worth is the present value of all net future cash flows, or in simple terms, I know that's a mouthful, The value of a company today is the sum of all the cash flow they will earn each year in the future, but what that cash flow is worth in today's dollars. A company's value cannot be measured entirely by its total sales, nor by its net income. We cannot necessarily say that just because a company has more revenue or net income that it is more valuable than its counterpart. A company is only worth the amount of cash it has left over after it has covered all of these expenses. That is what we mean when we say net cash flow. The net cash flow is the cash the company receives from its sales minus total expenses minus money spent on equipment or assets to grow the business. Call it capital expenditures. The formula is net cash flow that's equal to revenue minus expenses minus capital expenditures. This type of evaluation is referred to as a discounted cash flow analysis. A question. You are given the opportunity to choose from invest in either company ABC or company XYZ. ABC has a total annual revenue of $100 and is selling for $250 the share. XYZ has a total revenue of $80 and is selling for $300 the share. Which one will you buy? The answer, it depends. You can't judge whether to buy a company based purely off of its revenue. You will need to know the present value of its future cash flows and then determine which company to buy. Alright, are you ready to rock and roll? Here you can see the intrinsic value spreadsheet. Here you will find a template that will walk you through creating your very own calculation of the intrinsic value of a company. It may seem daunting at first, but it is really not that complicated, and it is a powerful tool once you know how to use it. The steps to use the discounted cash flow or DCF. The analysis tool. Number 1. Choose a company that you would like to estimate the intrinsic value for example, Apple, Google, Netflix, Ford, etc. Number 2. Use finance.yahoo.com or saks.com to input the information in the yellow boxes. Name, share price, share outstanding, revenue, net income, free cash flow. Number 3. Your two main assumptions are 1. The future growth rates, row 15 and 16, and the cash flow margin, the row 26. Look at the trends the company has had in the past. Think about if the future will be higher or lower, and make your best guesses. Remember that most companies have flat or declining margins over the time because of competition and technological changes. Number 4. In most cases, leave the discount rate at 12%. Also, in most cases, leave the terminal ground rate at 4 or 5%. Number 5. Play around with the assumptions. When you do, look at how the cash flow graph and the intrinsic value calculation changes. Number 6. In row 33, you will see the intrinsic value calculated. If the intrinsic value is significant above the current share price, then the stock is likely undervalued, and you buy it now. If the intrinsic value is below the current share price, then the stock is likely overvalued. Below is a snapshot of how your DCF model will look. Be sure you save your sheet to your own drive for future use. And so, when your dad's friend that works in finance says, "No way, you didn't really do that DCF in high school," you can prove it to him. He will probably offer you an internship on the spot. A couple of questions to consider. Number 1. The intrinsic value calculation was most sensitive to changes in which assumption? 5-year growth rate, discount rate, terminal ground rate. Number 2. What did you learn while playing around with the model assumptions about the value of a company? Number 3. Would you rather buy a very predictable company that had a 20% upside potential or a high growth company that has the 50% upside potential? The relative valuation method. A simpler, better known metric to estimate a company's valuation is its price to earning, or PE ratio. For companies with a relatively stable earnings prospect, The PE provides a reasonable approximation of the discounted value of its future earnings, as it tells the investor how many times 1 year's earnings the stock price is currently discounting. Thanks for watching. We hope you learn with our content. We will continue in next videos.